Good afternoon. Thank you for joining us for today's webinar, Insights from 2023 Anticipating 2024. I'm Sean O'Brien, President of QuickRate. And as always, I'm pleased to be joined by David Ruffin. David, you want to go ahead and introduce yourself?
Yes, thank you very much, Sean. Always a pleasure. Enjoy providing these quarterly updates and reviews with you, and look forward to today.
Awesome. Thanks, David. So again, a lot to cover today. Just a reminder on the different things that we do here. What we're going to talk about again, we'll look at the QCBI numbers from last year. David's going to share an outlook and an update on credit. We'll talk about some of the things that had us concerned in 2023, and certainly kind of I think are still lingering as we move into 2024. And then again, we'll just share some of the latest updates from Quick Analytics and IntelliCredit. Of course, we'll take your questions throughout. Certainly utilize the chat or the Q&A feature. We'll either take those in the midst of the conversation or at the end. As always, we will send out a link to today's recording as well as a copy of the slide deck. Typically, that takes us a day or two to get put together, but look for an email from us that will have all that information. As we began to do last year, and I think we'll continue to do this year, we just wanted to start off with some polling questions. I think we just have 4 or 5, so we'll certainly ask for your indulgence to answer these. I'll go ahead and get started with these, and we'll give each one about 30 or 45 seconds. But what concerns you most as you prepare for 2024? Just a single choice: rising deposit costs, deposits leaving your institution, credit quality, margin compression, or other. There's a lot of different things that banks are encountering, so we just left an option for other as well. So again, we'll just give this 30 or 45 seconds. We will include the results of the polling questions in the email that we send out. Okay. All right, we'll go ahead and end this poll. Let me share the results. You can see credit quality has moved to the top of the leaderboard. Last year, deposits were really kind of front and center. Margin compression just slightly behind. So thank you for answering that one. Let me go to the next question. Whoops. Wrong. On budgeting, are you budgeting higher or lower earnings than in 2023? So just a simple higher or lower. And again, we'll just give this 30 or 45 seconds. Okay, go ahead and end that one. So 58% are budgeting lower for lower earnings, 42% higher. So thank you for participating on that one. Next up, deposit levels. Do you see your level of deposits increasing or decreasing this year? Again, just a simple increasing or decreasing answer. Okay, this is encouraging. So you go ahead and share these. 60% of you see who responded see it increasing, 40% decreasing. So thank you again. Just 2 more here. Next up, what are your bank's 3 most effective credit quality first lines of defense? So you can answer multiple times here, 3 obviously. But again, risk rating, past due reports, stress testing, loan review, portfolio analytics, or annual reviews. With a huge focus on credit administration this year, we're just kind of curious what is most or at the highest priorities in the bank. Okay, this is great. Let me share these results. So loan reviews at the top of the list, followed slightly by past due reports and risk rating and annual reviews. So again, thank you very much. And now to our final question, just on macro conditions. What's your best crystal ball guess on the macro conditions for 2024? Improvement, deterioration, about the same. Okay. 68% believe about the same, 24% deteriorating, and 9% improving. So again, thank you all very much for participating in those, and we will share those results. All right, so let's kind of jump into, I thought we'd start with the OCC semi-annual risk perspective. So I just highlighted some of the bullets and comments that they made, not surprisingly for them, and David will talk more about this, but the risk in office market remains high, and they pointed out is expanding beyond the urban district. I think a lot of it had been contained previously. Clearly, for community banks, where 65% of our loan book is really made up of commercial and residential real estate. This subset of that, clearly is at the most obvious spot where weakness is certainly being realized. I think, they point out that consumers have been able to withstand, a lot that's been thrown at them. And it's, attributable largely to the fact that, unemployment remains at historical lows. Wages have risen, but we are reaching the point where cash reserves are starting to decline. I think this one, again, throughout 2023, I think we all felt the reduced market liquidity and competition for deposits. And again, I see that probably continuing through 2024 for the most of us. One of our polling questions around net interest margins, Mike Tierney from the Community Bankers of Michigan, I emailed about this. I mean, this is clearly something that, banks are struggling with. We're going to show medians and, kind of see directionally that there's pressure, but there's certainly a subset of banks who are really, being impacted by, contracting NIMs, largely obviously attributable to increases in deposits and funding costs. The OCC was quick to point out and continue to emphasize credit risk management and mitigation strategies, certainly encouraging stress testing, albeit whether it's at the portfolio level, but also potentially in subsets of the portfolio or with borrowers who might be sensitive to higher interest rates, and certainly any vulnerable loan segments, such as, as office. They pointed out that timely and accurate risk ratings are critical to ensuring an adequate allowance. We are at historic lows for the allowance. So, at a time where long-term asset levels in the bank are at, again, almost historical highs, we are at low reserve levels. So, making sure we're comfortable and confident in our analysis is critical. Risk rating, again, one of the choices in the polling question, certainly should be integrated and independently validated. And obviously, the most effective way to do that is through a strong third-party loan review, right? We really want to be challenging our risk grades to make sure they are representative of the risk that's contained in our portfolio. The growing consensus, seems to be, after a really strong 2023, that growth's going to slow here in 24. The deposit assumptions and understanding our deposit behavior is going to be, again, top of mind. And then, not surprisingly, liquidity risk and operational readiness is terribly important. And we are, as we began to do last year, should be testing those contingency funding sources as well. I'm not going to go through this slide in great detail. This is a slide from our presentation this time last year. But what I did is really kept it and updated it really for 24, because a lot of these same, conditions, are still with us, right? I think the expectation is this year, that there'll be some cuts in interest rates. The argument, and the parlor game about whether that starts in March, May, June. I think most people believe at some point by the second half of the year, we start to see the Fed lower interest rates and, try to continue to reduce the balance sheet while at the same time, making the economic conditions a little less restrictive than they are at this point. The economy has been stronger the challenge will be, can it continue to grow? And if so, can it do it with manageable and hopefully declining inflation rates? We touched a minute ago about that, the consumer is still spending, certainly at the lower economic, bastions. They are running and depleting their cash reserves. But while the pace has slowed, the consumer is certainly spending. The housing sector, again, remains sluggish. And again, the parlor game has been around inflation. It is moderating. The rate is declining. The overall level is still high, but the rate is declining, and the Fed certainly hopes to have that under 3% by the end of the year. So again, headwinds, we still, live with this inverted curve. It certainly has been a precursor for recessions. Certainly wasn't the case in 23. Hopefully it won't be the case in 2024. Credit quality, as we touched on, has been stellar. Reserves are, at low levels because of the stellar credit experience. Will that normalize in any way this year? Certainly something to watch. And as we talked about, these higher normalized rates will just continue to put pressure on our bank deposits, right? I think particularly our non-interest bearing. We had our board meeting at the community bank that I'm a part of this morning. We track and just the transition of our deposits. Not only the mix from non-interest bearing and non-maturity into time, but also the deposits that left. And clearly, we feel a little bit better that the deposits the outflow has slowed. But certainly we're mindful this year that it could return. But we recognize that those non-interest bearing deposits are just going to continue to remain under attack from other institutions, from fintechs. That unfortunately probably is now a lot more normalized for our customers, and we just have to defensively and offensively prepare for that reality. So as I kind of already touched on this, deposit levels and pricing and expectations are going to remain a priority. The one thing though, I think we saw in the fourth quarter was this realization that we're clearly probably closer to the end of interest rate hikes than we are at the beginning. I think we saw a huge shift in the level of underwater security portfolio valuations, right? They clearly lessened as we closed out the year. I'm sure the M&A folks are happy for that, because that probably will help maybe unclog some of the lack of M&A activity that occurred, because no one really knew what to make of those security portfolio valuations and who was going to absorb that. So we probably have seen that impact lessen, and we have a slide on that here in a bit. Again, I have this in here. These are all just kind of reminders. The game, right? And the drill. Just the decline in credit quality can lead to liquidity problems. So we certainly want to be mindful of and kind of dust off our best practices, monitoring our large borrower or our large depositors. Increasingly, it's important to recognize both our level of uninsured depositors, but who in fact they are. And again, just practice all the basics of working our local markets, complementing that with wholesale funding. I will note that the Bank Term Funding Program expires in March. I'm not sure. I don't think there's that they'll renew that, but if they do, that's one thing. But if not, I mean, that certainly probably leads to an increased level of borrowings for banks who had participated in that, and we'll see what comes of that. But that's set to expire here in March. As I mentioned, the level of underwater security portfolios has certainly lessened. You can see the difference between 9/30 and 12/31. The number of banks, who were anywhere under 5% tangible capital, has certainly been reduced. So that's encouraging. And again, I think this, again, hopefully doesn't create a problem for any bank should they experience any credit quality. It certainly was a hamstring. There could be a hamstring if you do experience any credit issues. But fortunately, this problem, was certainly lessened or weakened as rates, moderated a bit here in the fourth quarter. So let's look at the QCBI numbers again. These represent median values. So again, I think this is an area that we'll probably look to refresh, this sometime this year. Some of these reports maybe get a little bit more granular. As most of you know from previous, presentations, I'm a big fan of directional. And so, this is good for that, but we also probably want to dig a little bit deeper on some of these metrics. But loan growth, and David will touch on this, you can see certainly moderated, from 2022 to 23. Not surprisingly, 13% of the banks in the country didn't experience any loan growth. Deposit growth, this was clearly the most, I think, acute and meaningful last year. You can see, a large number of banks, 46% of the banks in the country, community banks in the country, saw lost deposits over the last year. That was an increase from about 33% of the banks in 2022. So that's a large percentage of banks for over a 2-year period of time who saw deposit outflows. So again, that is going to remain critical for us. And as you can see in the bottom slide, most impacted were the banks below 250 million. So a lot of work to be done there, trying to regain some deposits in our institutions. Fortunately, we were able to pass on pricing on our loan portfolios. However, that was obviously countered by a huge increase in the cost of funds. Again, at the median, NIMs stayed better than what you might expect. Actually showing an improvement. But as I touched on, again, that's not to minimize the impact that NIM compression is having, for a large number of banks. Non-interest income was about flat, and then the efficiency ratio clearly, as you can see, ticked up at the median. So this page in particular is probably a page we'll work to get a bit more granular on this year for future quarterly presentations. All that said, pre-tax ROAA dropped at the median from 119 to 112. You can see 5% of the banks actually were negative on ROA this year. Core operating earnings, again, for those of you familiar with Quick Analytics, is a metric that we focus on, really, captures the earnings powers of the bank. Has declined now, as you can see, really starting in 2019, we've been on a declining trend, albeit at the median slight, but still that's a troubling trend that continues to go. So hopefully 24 is a year where we can reverse that. 4% of the banks, as you can see, with negative core operating earnings. Median ROAA then, after tax, you can see again dropped from 94 to 88 bips. And again, 5% of the banks showing negative ROA and ROE in the slide below. So again, I think really an incredible job by banks again in 2023. Certainly hats off for that. But 2024 is going to present a new set of challenges with a backdrop that's a little cloudier than maybe we were here this time last year. Again, facing many of the issues that we thought would surface last year, made perhaps a chance better surfacing here in 2024. So at this point, and with the polling question where credit quality is really the issue that probably concerns most of us as we enter 2024, I'm going to turn this over to David to take the screen and keep our presentation going here. David, the screen is yours. I'll tell you when I see it.
Okay, great. Let me get on this. Can you see it?
Not yet.
Okay, let me get to the share screen piece here. Let's see here. I hit the share screen. Sorry about that.
That's right.
You gave me permission, correct?
Yep, I stopped it. So you should let me make sure I say that. Let me make sure you. Yeah, let me try this. Maybe you didn't have permission, so maybe that was on me. I just made you the host, so hopefully that
Okay, can
you
you?
didn't have it. Oh, beauty of live TV.
So I apologize. I don't know why it's not
Yeah, I can pull mine back up.
okay, if you don't mind.
Yeah,
All right.
I'll pull it back up and I just will have you move the slides. Can you see my screen, David?
Uh, let's see here. Yes.
Okay.
Okay, so again, if we go to the next screen, again, I apologize for the technical problem here, but if you notice that the entry, speaking of the QCBI, this is important in these trends because there is a story here under the $10 billion asset banks, which we obviously track, and I think most of you on this presentation are in that category. If you notice here, we've got the NPLs or non-performing loans to loans have ended their kind of decline that was obviously affected a lot by the government largesse and the money to avoid an economic problem with the pandemic. Charge-offs have begun to tick up. And then you'll see in terms of the allowance for credit losses to loans, you're seeing a general decline. There is also another little subset story here. It's the Northeast banks, which have had traditional in the last 3 or 4 years that I've been sharing this presentation with Sean, have had some of the highest quality. They have at this point the lowest reserve. So on the face of that, that would make sense. But then if you look at the next slide, which would be the ACLs to NPLs, here's the concern. Sean already alluded to it. Reserves, particularly at the smaller banks, seem to be a little bit at rock bottom right now, but that has to be looked at in the context, I think, of other issues going on. And obviously, the big elephant in the room seems to be CRE, as he's already alluded to. Large banks have increased their reserves over the last 2 or 3 quarters. The smaller banks have decreased, but yet counter to that, the larger banks are shedding some of their CRE exposure, and the smaller banks and smaller regionals have actually increased. In fact, you could argue that almost empirically proven that the bulk of all that loan growth that's happened post-pandemic, admittedly tempered of late, came at the result of even taking more CRE exposure at the small banks. So next slide. So the issue there is credit performance are still good, as alluded to, but stress seems to be in the public awareness. That's also being proven by your polling results. I think for the first time, Sean, we've asked anything about credit. It has never been front and center in the several quarters we've been sharing this presentation. Next point, initial underwriting continues to be very, very stellar, historically good. The issue still remains some of the servicing or the post-booking servicing and analysis. Some of that's still trying to get current information from borrowers and the like. So the monitoring still needs to be focused in terms of enhanced. That's certainly coming up in much of our loan review work as we see it. Despite the commercial focus that we've certainly been, loan demand is moderating, but we also need to keep an eye on vintages. We like to think of vintages as being not so much wine as vintages. When were these loans booked? Arguably 75% of the loan losses that occurred in the great financial crisis occurred on loans made 18 months prior to the major problem that we had. Again, despite our focus on commercial performance and business performance, it would be foolish, I think, for bankers to ignore some of the weaknesses that are emerging in some of the consumer. I like to think of it as you've got the consumer population divided into a more affluent, that has more liquidity at their hands than others that are literally living paycheck to paycheck. They're running up significant balances on credit cards and so forth. And I think that, again, that's not something that you can look at as having any immunity to commercial businesses. Consumers still basically are at the heart of business income eventually. So the next issue is a little bit reality, but it's something I feel like I owe the audience here, is to remind people that regulators are now beginning to be much more, if not aggressive, certainly more scrutiny being applied to credit quality, and also particularly given the fact that credit metrics have not yet deteriorated significantly, the credit process issues are becoming much the focus of the regulators. Unfortunately, we're seeing more MRAs, or matters requiring action, being issued by regulators, particularly along the lines of CRE. There's estimates now that $2 trillion of CRE repricing is ahead of us between now and the end of next year, 2025. That's going to have a huge impact, again, on the ability for loans to be repaid under the structure that they were originally approved. But again, to quote James Carville, the famous political guy of the 90s, it's really about the CRE, stupid, it seems. And that's where the total focus of a lot of concern in the regulatory environment is. Next slide, sir. So let's take a look at CRE. And this goes to, again, to the data we look at, that we segment from a regional standpoint. If you look at the right chart, which is the broader CRE 300%, you're looking at both the West and the Northeast as having larger percentages of their risk-based capital banks that are allocated to this. And remember, I said a moment ago, the Northeast was actually the lowest in terms of reserves. So that whole dichotomy about where risk may be embedded in your portfolio versus where you're reserving for it, I think is an area that we like to remind our clients that they have to keep an eye on. The 100% guidance, which is the chart to the left, is really more focused, as you know, on acquisition, construction, and development lending. Not unpredictably, the Sun Belt, the Southwest, and the Southeast are a little higher in that, because common sense tells you that should track economic development and migration of populations and so forth. So what we normally do is also the next slide, please. We look at other concentrations that are typical front of mind. One concern I clearly have, and I know this is controversial, some people don't believe this, is that there is a building bubble in multifamily. Typically what happens with multifamily is that it thrives when 1 to 4 family housing is in trouble. And when I say trouble, I saw just in the financial news this morning that rates went way back up again, over 7% in the mortgage, because of some of the January inflation numbers. There's been a lot of hope even 6 weeks ago that all of that had abated and we weren't going to. But my point there is, typically multifamily, the issue with multifamily is the time it takes to get on board. There's some of the cities in the Sun Belt, they're still in the newest phases of construction of multifamily. And many of us who've been in the credit world before understand how bubbles develop in multifamily. Then you go through conversions into condos and free rents for 6 months, things of that nature. So I do think, as you can see these numbers here, the community banks, the smaller banks, are increasing their exposure to multifamily, and I think it does merit more vigilance. C&I, of course, has returned to the pre-PPP lending environment in terms of its general concentrations and against risk-based capital. And not surprisingly, the Midwest shows the highest of exposure to that in terms of agriculture. So next chart. As I said, the headlines totally dominating by the financial press, or in the financial press, about CRE. I do think it's important. Sean alluded to it. I was actually in a conference last week in Texas that the chief economist of the American Bankers Association really dove down pretty granularly on office. He said that's getting quite a bit of press, as we all know. Now, we also know probably not many of you on this call have direct exposure to office lending, office building lending. But this goes to the whole broader point of I think the task in front of all of us is to dig deeper and to tell a story that has a lot more granularity to it than just the headline figures. For example, purportedly 44% of office space is already underwater. But his point was, I thought interestingly, that arguably 30% of the buildings have 90% of the vacancies, and many of these are not any more Class A. They're buildings that have age to them and what have you. So it does, I think, behoove us all to kind of look at, well, what are we really talking about? And I think it's going to be important to explain, particularly to regulators, what comprises any of these, not just broader CRE concentrations, but what are the subsets within them. Another broader issue in terms of refinancing, and Goldman Sachs came out the other day and said that arguably almost 30% of S&P 500 businesses would be unprofitable if they had to refinance at today's rates. The other issue, I think, is pertinent on these last bottom headlines because, a lot of the publicly traded banks are getting hammered because of their exposure to CRE. Even over-the-counter investors, smaller investors, that you can't completely divorce that away from smaller banks who are perceived to have, again, inordinate exposure in CRE, particularly as it relates to what now appears to be the source of recent loan growth at banks. So again, that's just part of the, this is not to try to doom and gloom. I'm not into that kind of thing. I just think being aware of awarenesses, circumstances, particularly where the regulators may be and investors may be, I think is critically important to our defense of our own portfolios, which unfortunately I think is going to become much more focused, the focal point of our activities than frankly it has been in the last 10 years of very benign credit. So next slide, sir. I showed this last quarter. It is rather alarming. It shows again the amount of increased CRE on a national marketplace scale, but also the proportional amount of bank assets at the smaller banks and smaller regional banks that are focused on CRE, which just unfortunately puts a bigger bullseye on our institutions. Next slide. It is important, and I know this from working with specific clients, that the regulators are dusting off the old 2006 guidance on expectations that banks have on adhering to those guidances. Remember, they're not regulations, they're guidances, but not adhering to suggestive steps to be taken to manage those risks, I think would be a fool's mission for smaller banks in these days. And also remember the June 29th interagency guidance that came out about workout protocols. And one of the things that we are beginning to see is people getting a little more concerned about where would they see that or have that talent available to them should we get more stress to actually rear its head, which it hasn't really at this particular point. But again, it appears to be heading that way. Next slide, Sean. So here's specifically what we are recommending to our clients around this CRA. It's not, I don't think it's, you don't want to hear, well, this and that's going on. What do you want to do about it? What should we do about it? I think, first of all, most importantly, retweak your current policies. Don't be caught with the regulators looking at a 2015 or 2016 policy that may have been in today's perspective rather liberal or aggressive. Make sure you're focusing on the tedium. Yes, it is a tedious process to try to tweak policies, but be absolutely sure your current policies relative to particular CRE reflects the current environment in which people now deem it to be a significant risk. Again, get well beyond a theme of the MRAs we're privy to has been the regulators feeling like the banks are just hanging on to 300, 100 guidance and not digging deeper enough into the subsets that are idiosyncratic to their individual loan portfolios. So I do think putting a lot more energy in those, so what we call subset analysis, is going to be critically important going forward. You know, that also includes, of course, enhancing local market data in the areas that you've got concentrations. Embrace stress testing. Understand, as Sean alluded to earlier, it has a different aspect. You know, one stress test doesn't fit all. There's everything from the broader entire balance sheet into the capital account stress for the institution, certainly the portfolio level, but now a lot more focus on loan level. We particularly favor what we call a companion stress test to loan review, which is done concurrent to the actual loan review itself. But I do think understanding and mixing and matching stress tests of a variety of approaches may be in order in the next couple of years. We also think that making sure that your board is aware of all of these changing currents and your changing policies and your improved analyses, and make absolutely sure that none of this is left to just verbal discussion. It needs to go in the minutes of your board meetings, that the board has been apprised of the steps you're taking to improve your oversight of credit risk of the commercial real estate. So again, all that's leading, you've heard this me say this many times before, it's imperative that you write your own credit risk script profile before the regulator does it for you. Yes, sir. Next slide. In terms of what the investors are showing, yes, that's right. This comes from the annual AOBA conference held in Phoenix, which I was at in late January, and the head of CEO of KBW would show in this chart, obviously, that credit risk is the big kind of elephant in the room. Much of the projections of valuations, profitability, even deal flow is in many ways the big variable is the credit quality issue. Is will there be any issues emulating from that? The other piece that we've talked to several times, the next chart there, is to indicate this is an ongoing headwind that commercial banking is facing, and that is all but consumer purpose lending is now, commercial bank is the minority provider. In other words, all the non-bank providers of credit are now exceeding the collective credit generation by commercial banks. Now, there's not altogether a bad side to that. I think part of the structural risk that we faced 10, 15 years ago in banking, frankly, has been taken out of the industry by some of these non-bank credit providers. So there is a mitigant to some degree of that, but it does affect your ability to get credit out there, to grow loans and to provide the needs of your legitimate borrowers and so forth, a headwind that frankly most commercial bankers didn't have 10 and 15 years ago. Okay, next slide. And relative to the other aspect of kind of what the investors think, this is a fairly dramatic chart, and admittedly, it's not adjusted for inflation. But if you look at the roughly, what I think it was about 415 bank failures during the so-called financial crisis over a 4-year period, we've only had 5 since the beginning of 2023, 5 failures, that is. But look at the cumulative assets that were involved in these just few bank failures. We all know, as community bank-oriented people, that we're kind of tired of explaining that 2 or 3 of these were highly idiosyncratic in their lending and their funding. But the reality is that, again, that's what the FDIC is looking at. Look at all of these bank assets that already have been tied to failed banks. The other thing that I know there's a lot of hope for, certainly by the investment bankers, to get the M&A business back on track a little more. I think 23 arguably was one investment banker said it was the lowest volume in 40 years in the banking industry. Part of that was uncertainty. Part of that was obviously a good bit of that was deposit and funding related, not credit quality oriented. But what we are seeing in the few deals that we've been involved in too, and the low volume in that generally, according to the Hubdy people, is that the loan portfolio credit marks, which of course is the discount applied to a portfolio being looked at for potential acquisition or merger, is running about 1.5%. The other piece that has commanded far more attention during even M&A discussions, for obvious reasons, is the so-called interest rate mark, which is averaging about 3.5%. That should be tamping down a little bit because of what Sean was alluding to, but I do think that's always important. So next slide. In conclusion, let's sum this up. I have published an article in the last couple of weeks that kind of goes to this point. And frankly, I got the idea from a banker on the West Coast who said, well, looks like we've dodged the recession bullet. And we're already strategically on to figuring out how we grow our loan portfolio. And it made me realize of something, and I came back and I asked our team, can we show what we intuitively know, which means that once the Fed stops capping rates, there tends to be a trailing reality to when NPLs or non-performing loans themselves cap. And that obviously was proven during the great financial crisis. And unfortunately, we've just taken the liberty in this chart to potentially show at the same, velocity where NPLs conceivably might go in 18 or 24 months. We don't know that. No one has that kind of crystal ball. But I think for those of us in the credit management business, that is a reality that an immediate change in the Fed's philosophy on rates doesn't automatically effectively change credit risk. There is a significant trailing indicator there, or reality. Next slide. And again, in summation, it really is about, we've got a lot of positives to look to. We've got reserves, even though they're relatively low. We got more capital. We got improving capital because of the rate of the investment issues improving. There are some risks clearly in our left, as I said, have left our space. Inflation appears to be abating, although that it may be a month to month kind of up and down kind of situation. The bad, though, is, again, we've got to accept that CRE exposure has increased in the last 1.5 to 2 years at the smaller bank level, which is going to clearly mandate more regulatory scrutiny. We just talked about the trailing effects, and then again, the concern with some consumer segments. But I think what we are really needing to again focus on, which I've mentioned several times before in the previous quarters, loan reviews, stress testing, better portfolio analytics, write your own credit script before the regulator does it, and most importantly, do everything in your power to avoid too many credit surprises. That tends to be a very toxic reality when it comes between bank boards and bank management, as well as banks and their regulatory groups. So again, I apologize very much for the technical part of not being able to share my screen here. Sean, thank you for the help on that, but I'll hand it back to you.
Yeah, no worries, David. And David didn't mention it, but he put the picture there, right? That's his most recent article. From found in Bank Directors. So we'll be getting that out to all of our customers as well. All right. So again, just we'll move through this slide. I did want to share, as David said, they've been busy at IntelliCredit. We continue to grow this side of our business. If you haven't taken a look at us, we certainly welcome an opportunity to discuss it with you. Again, a number of different tools that we not only use in loan review. Don't think about us just solely for loan review. The tools that David and the team use for loan review are available to you to internalize at the bank and help, as David said, write your own credit script very effectively. As we mentioned, we do a number of different things. The annual the smart loan review, again, the service, but internally, the portfolio analyzers allows you to get better analytics about your portfolio. The annual review and smart loan review functions, again, can really streamline those processes and capture it all, in one, effective dashboard. I think the thing that we find, or that our banks find, is the fact that the integration, there isn't any. So it makes the installation and getting up and running a lot easier than you would anticipate or might be fearful of being able to do. So, certainly encourage you to do that. And to that end, as we've done often here at Quick Rate and Quick Analytics, we don't want you to take our word for it. We're willing to put our money where our mouth is. And certainly, this year wanted to, offer a 6-month free trial to anybody interested in trying to learn what IntelliCredit's all about, how the portfolio analyzer can assist you and your team at the bank. So, we'll be talking a lot more about this, throughout the year. We've got some upcoming presentations where we'll focus on this. But given the large audience we had here today, we did want to share this with you. So certainly reach out to us at info@quickrate.com or at info@intellicredit.com, and we can get a conversation started. A couple of other presentations that are upcoming. Friday, we welcome back our good friend Paul Allen from Saltmarsh. Paul is going to join us to talk for our coffee talk. We've got a number of interesting topics, obviously, validation, kind of year-end review, best practices as we move forward this year, what Paul has seen, from their clients around not only credit, but also just the ACL and CECL. So we'll look forward to speaking with Paul on Friday. And then also the following Friday, we are going to do a coffee talk and begin a series of coffee talks around IntelliCredit. So again, I think one of the things we really want to do is unwind and unwrap take some of the mystery out of, what the tool can actually do for you. So we want to make that interactive. We want to involve you. We want you to be able to take it at your own pace. So we feel this along in conjunction with the 6-month free trial is a way for our potential users or prospects to learn more about IntelliCredit, to get more to see how it can help you. And again, not do it by simply taking our word for it, but actually be interactive and grow and learn as we move forward. I did also want to just reference, again, we want to thank you all for participating in all these webinars that we do. We're really grateful for the participation and the interaction, and we have begun to increasingly put these out on a YouTube page, so you can see at the bottom of the list the playlist or the link to go to our YouTube page. So if there is an older webinar that you missed the email getting the link to, you can probably find these on our YouTube page. And increasingly, we're starting to use Loom videos and other Zoom videos to even in some of our customer service things, with Quick Analytics. So again, I think this is something we just want to make you aware of. We're going to try to, again, make this more front and center. But for those of you who weren't aware that this is out there, I certainly encourage you to take a look if there's something you want to see historically. I don't see any questions. So again, thank you all very much for taking time out of your busy day to join us. As I said, we're really heartfelt for the appreciation that you show up every quarter. We'll be back next quarter with another update. We'll be, again, the next 2 Fridays, be on the Zoom for coffee talks, and certainly look forward to hopefully speaking with you soon. David, any final comments or thoughts for our group before we let them go today?
No, I just want to thank them for participating, and reach out to us for any issues or concerns, and we'd love to again get into your RFP queue for loan review. Yeah, certainly. Like I said, we're going to talk about portfolio analysis, but as David mentioned, right, we welcome the opportunity to quote or get in your RFP process for loan review in the coming years. So again, on behalf of David, thank you all so much for joining us. Really appreciate the participation, and we will look forward to speaking with you soon. Bye now.